Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about the Bank of East Asia Limited annual report. The Bank of East Asia Limited offers a wide range of banking and financial services to its customers. At the heart of its operations are personal banking services, which include deposit taking, foreign currency savings, remittances, mortgage loans, consumer loans, credit cards, cyberbanking, retail investment, and wealth management. In addition to these core services, the bank also provides wholesale banking services, including syndicated loans and trade finance. Its Treasury Markets division offers a range of financial products and services, such as foreign exchange margin trading and broking services. The bank's wealth management arm provides private banking services, while its renminbi services cater to customers with business interests in China. The Bank of East Asia also operates in the Chinese mainland, Macau, Taiwan, Singapore, Malaysia, and the United Kingdom, providing a global reach for its customers. Its mandatory provident fund services are another key offering, demonstrating the bank's commitment to meeting the diverse needs of its clients. Overall, the bank's comprehensive range of services makes it a one-stop shop for all financial needs. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified by examining the key factors that have contributed to an increase or decrease in revenue for a financial institution. On the growth side, non-interest income has been a significant contributor, growing by 28% due to diversification of income streams and increased fee-generating activities. Other notable drivers include double-digit export growth, robust IPO activity, and the success of digital platforms such as BEA SmartTrade. In addition, collaboration among different geographic locations has outpaced standalone revenue growth, while customer acquisition across various segments has also been a key driver. The institution's bancassurance business has seen significant growth, with 29.5% increase in annualized new premiums. Furthermore, the introduction of enriched product offerings and upgraded digital channels has contributed to revenue growth. On the decline side, net interest income has declined by 7.3%, primarily due to a narrowing net interest margin, NIM, resulting from reduced interest rates. Weakness in commercial real estate, CRE, has also impacted asset quality and property valuations, leading to impairment losses on financial instruments increasing by 3.2%. Low single-digit growth in loan balances is another factor contributing to revenue decline, attributed to subdued credit demand and de-risking efforts. The net income of a company has experienced significant fluctuations over the past year. On one hand, it decreased by 24% to HK $3,501 million, 1.9% to $9,634 million, and 11.9% compared to the previous year to HK $3,332 million. However, in some instances, net income increased, such as a 45.2% rise to HK $155 million. The profit margins of the company have also undergone changes. The return on average assets decreased by 0.1 percentage points to 0.4%, while the return on average equity declined by 0.9 percentage points to 3.1%. Furthermore, the cost-to-income ratio increased by 0.8 percentage points to 46.7%. The reasons behind these changes are multifaceted. Ongoing challenges in cross-boundary lending opportunities have likely contributed to the decline in net income and profit margins. Additionally, additional impairments on Chinese mainland and Hong Kong CRE accounts have also had a negative impact. The subdued credit demand and efforts to de-risk the CRE loan portfolio may have further exacerbated these issues. Overall, the company's financial performance has been affected by various factors, leading to fluctuations in net income and profit margins. The company is indeed generating positive operating cash flow. This is evident from the various financial metrics presented in the summary. Firstly, on page 228, it is stated that there is a net cash inflow of $15,053 from operations, indicating a positive trend. Furthermore, on page 229, the net cash from operating activities for the year 2025 is reported to be $92,648, which is also a positive figure. This suggests that the company's core business activities are generating sufficient cash to cover its operational expenses and investments. Additionally, on page 251, it is explicitly stated that the company has positive operating cash flow, reinforcing this conclusion. Finally, on page 359, the operating cash flow is reported to be $118 million, which is a significant positive amount. Overall, these figures collectively indicate that the company is generating sufficient cash from its core operations to sustain its business activities and investments. The company's financial situation has undergone notable changes regarding its debt levels and interest expenses. On one hand, the data reveals a decrease in interest expenses across various categories. Specifically, interest paid on debt securities issued decreased from $19 million to $6 million, while interest expense on loan capital issued dropped from $1,404 million to $1,338 million. Additionally, total interest expenses saw an 80.2% decline. However, the picture is not entirely consistent when examining the company's debt levels. While there are instances of a slight increase in debt, such as a 0.9% rise, other data points indicate a decrease. For example, the total debt level decreased by $387 million from January 1 to December 31, 2025. This mixed trend suggests that while interest expenses have significantly decreased, the company's debt levels are not uniformly increasing or decreasing. In conclusion, the changes in the company's debt levels and interest expenses indicate a complex financial situation. While there is evidence of a decrease in interest expenses, the data on debt levels presents a more nuanced picture. The financial performance of various segments and regions within the company has been mixed. On a positive note, Macau branch, Taiwan operations, Singapore branch, BEA Union Investment Management Limited, Hong Kong operations, corporate segment, intertreasury markets management, and wealth management all performed well. These segments saw significant growth in income from trade finance and treasury services, as well as resilient performance amidst a complex global investment landscape. In contrast, overseas operations struggled due to compression in net interest margins, NIM, and reduced commercial real estate, CRE, exposure. U.S. and U.K. operations also faced challenges due to credit downgrades on certain CRE and hotel exposures, leading to increased expected credit losses. Additionally, overseas and Chinese mainland operations, Taiwan operations, personal banking in Macau and international markets, and other Asian countries all experienced significant impairment losses. The Hong Kong market was a notable exception, with operating income increasing from $13,446 million to $13,932 million. However, the mainland China segment saw a decrease in operating income from $5,044 million to $4,906 million. The interregional segment also experienced a decline in operating income from $322 million to $429 million. Overall, while some segments and regions performed well, others struggled with significant impairment losses and decreased operating income. Management is optimistic about the company's outlook, citing several key strategies that will drive growth. The bank aims to become a trusted and preferred banking partner in Greater China and beyond by diversifying its business and building a sustainable platform for future growth. A key focus area is digitalization, with the goal of driving fee-generating activities and sustaining growth. The wealth management business is identified as a major growth driver, with plans to expand the sales force, enhance investment products, and leverage partnerships with Chinese mainland banks. The bank also aims to capitalize on opportunities arising from greater mobility and integration in the Guangdong-Hong Kong-Macau Bay Area, GBA. Management emphasizes the importance of sustainability leadership, net zero goals, and green finance efforts. In terms of specific targets, the company aims to achieve 17.8% of total corporate loans and bond investments in green and sustainable finance, GSF, by the end of 2025. Additionally, management is committed to fostering a positive working culture that promotes core values and encourages open communication through town hall meetings and anonymous feedback mechanisms. Overall, the outlook for the company appears positive, with a focus on sustainable growth, digitalization, and strategic partnerships. Management is confident in its ability to capture opportunities in the GBA region and maintain Hong Kong's position as an international financial center. The company's financial history reveals a notable trend. On multiple occasions, it has been confirmed that the company has indeed paid dividends to its shareholders. This indicates a commitment to rewarding investors for their loyalty and trust in the organization. A review of the provided documentation further supports this assertion. Specifically, page 5 explicitly states, has paid dividends. Yes, providing clear evidence of the company's dividend payout history. Additionally, on page 168, a summary reiterates that the company has paid dividends, reinforcing the notion that shareholder returns are a priority. Unfortunately, there is no concrete information available regarding share buybacks. Despite this omission, it is evident that the company's focus on dividend payments demonstrates its dedication to creating value for shareholders through regular distributions of profits. Concerns about inventory buildup and supply chain disruption are evident in various aspects of the economy. The average liquidity coverage ratio for the fourth quarter is a worrying -21.8%, suggesting potential issues with liquidity that could lead to supply chain disruptions. Furthermore, trade barriers such as relatively elevated tariff rates and uncertainty over global trade patterns pose significant risks to supply chains. Additionally, investments in AI may impact labor markets, exacerbating these concerns. The presence of other economic indicators also points to potential inventory buildup and supply chain disruption. Fragile consumer confidence, elevated borrowing costs, high office vacancy rates, and U.S. tariffs all contribute to a complex web of challenges that could disrupt supply chains and lead to inventory buildup. That concludes the financial summary for the Bank of East Asia Limited. Feel free to comment below, and I will be happy to answer them when possible.